Well, thank you, Svein, for having us and take a few minutes to answer our questions. Well, first of all, I want to ask you about how do you assess risk credit in DNB AM's fixed income strategy right now in this market situation?
Yeah, it's a little bit difficult because if you look at credit risk and the pricing of credit risk now, we are pretty convinced that credit spreads are at attractive levels if you have, I don't know, an investment horizon of 2 or 3 years. The shorter term picture is a bit more difficult. It's kind of unclear. So problem is that if you should actually buy credit now because it's cheap, but then also there is a risk that it might become even cheaper. So the way we have tried to kind of handle that is that we have run our portfolios on the high yield side with somewhat more cash than normally. The investments are still in high yield, but we have a somewhat higher cash balance to kind of mitigate the short-term credit risk a bit.
So you are right now shifting maybe towards a more defensive position?
Yeah, that is what the kind of the higher cash balance entails. It's a bit more defensive. Yeah, that's right.
And last but not least, after seeing the fund picture, I have this question: why do you focus especially in the BB plus to B plus debt rates? And have you seen improvements in this debt segment since the lift of rates by central banks?
Okay, I think the reason that our high yield product focuses on the double B, single B plus area is part of the strategy for the fund. And the rationale there is that it's just that empirically, if you look at return on different asset classes within the fixed income market, you will find that typically the double B, strong single B to double B area is the rating category with the highest risk-adjusted return. There is both academic research and you have Illman and you kind of long-term time series from the US, for instance. So it's an area or a rating category with strong risk-return characteristics. So that's, as I said, that's part of the strategy of the fund. And then if you look at the more short-term picture, whether the credit outlook for that category has improved, I would say that if we keep within the high yield universe, clearly risk markets, equity markets, credit markets have been quite weak so far in 2022, and that would imply that in relative terms at least, the double B, strong double B category has improved relative to the single B. But I think it's hard to say that the overall outlook for those rating categories has improved. That is not what happens when we're looking at an economic downturn. Then you need higher credit spreads to compensate for increased or future increased default rates. So yeah.
Okay. Well, that's it. Thank you, Svein.